Students, welcome back. In the previous section, we have seen the Modigliani and Miller approach, where he says the capital structure doesn't have any impact on the work. End of the day, the work remains constant, and for that he makes some certain assumptions. One of them is perfect capital market, and in perfect capital market, there is no tax burden. But in real market, in real scenario, it never happens. In your market, the tax is always there. So once you have a debt, debt pays interest, and the interest is charged before the tax is paid. Therefore, interest is tax sealed. Interest saves the tax. Because of the interest, the corporate tax is saved. Therefore, corporations can deduct interest expenses, and because of that, uh, uh, the tax amount is being reduced. Here is an example. Consider the impact of interest expenses on taxes paid by Kroger Incorporation. In 2015, Kroger had earnings before interest and taxes 3.58 billion. Interest is 480 million. So this will be deducted before the tax is paid. Therefore, the tax amount will be reduced, and on the reduced taxable amount, 35% will be charged as tax. So the final tax bill will be lesser than a situation where there is no interest will be there. See, two scenarios are created. One is with leverage, the other one is without leverage. See, for example, come to the spreadsheet, please. Yeah, here is Kroger Incorporation. The black fonts are the given data. So EBIT is given as 3580. Two scenarios are created here, with leverage, without leverage. Now, if there is debt in the company, debt will have tax. So in the tax budget given in the question is 480 million on 3.58 billion. So 480 million is deducted here with leverage. If the company is not using any leverage, all equity, then there will be zero interest, isn't it? Therefore, income before tax, or the taxable income is 3100 for with leverage scenario, 3580 for without leverage scenario. See, your taxable income increased without leverage. Because taxable income increase, tax bill also will increase because you are paying 35% tax. So the tax bill will be, the tax you have to pay is 10885 with leverage, 1253 without leverage. So with leverage, just 1.085 billion will be the tax. Without leverage, 1.253 billion will be the tax. So you are paying unnecessarily too much of tax, around 200 million extra tax you are paying if you are without leverage. Therefore, net income will be 2015 with leverage, 2327 without leverage. Now calculate. Interest paid to the debt holder is how much? 480 with leverage, 0 without leverage. Income paid to the equity holder, the net income 2015 with leverage, 2327 without leverage, calculated above. Total payment made to all investor, debt and equity holders. With leverage 2495, without leverage 2327. Who is better? Your investors are getting 2495 if you have with leverage. Your investors are getting only 2327 if you are without leverage. And that one, the difference between these two is the interest tax shield. The difference between these two are interest tax shield. What is interest tax shield? That is corporate tax rate multiplied by interest payment is equal to interest tax shield ITS. You can remember this as ITS. So ITS is equal to tax rate multiplied by interest. Let us see here. Your tax rate is how much? 35%. Your interest is how much? 480. 35% of 480 is how much? 168. This 168 you add with the without leverage, you will get 2495. Cash flow to the investor with leverage is equal to, I have just added the interest tax shield ITS with the without leverage. If you add this ITS with this cash flow without leverage will be equal to cash flow to the leverage with leverage 2495. This is equal to this. This we have calculated through the statement. This we have calculated through the ITS. Both are same. Therefore, because of leverage, the company has got 168 million of ITS, interest tax shield, or saving to the company. That saving goes to whom? To the investor, of course. That's why this, once tax is there, then the proposition will not work, because tax definitely saves the interest saves the tax burden, tax bill. Therefore, it goes to the directly, indirectly, it goes to the investor itself. So this is what the 16.4 equation says. ITS is equal to corporate tax rate multiplied by interest payment. Here is another question given. Income statement is given. So let us go to the spreadsheet, please. This is ECB income statement 2010 to 2013, and the total sales is given here. The font in black is the given data, as you know. So sales minus cost minus SGA minus depreciation will be the operating income. Add other income will be the EBIT, minus interest expenses will be equal to income before tax or taxable income. Now tax of 35% is equal to net income. Now the question in this scenario is, what is the interest tax shield of the company? ITS formula, what is ITS formula? Very simple, income tax rate multiplied by interest amount. So tax rate is 35% multiplied by the interest amount 50 million. 50 million multiplied by 35% is equal to 18 million. So 18 million, 28 million, 35 million, 35 million. In 4 years, you are saving tax of, in 4 years period, you are saving tax of 115.5 million. Extra cash available to the investors over the last 4 years is the saving in tax because of debt interest payment is made. Debt interest payment saves the tax. How much is tax saved for this company? For ECB, EC Builders, the tax saved is 115.5 million in last 4 years, and it is the actual income statement of 4 years of ECB. So this is the way the tax is being saved because of the interest. It is being discussed in the spreadsheet there. 115.5 million is saved as the tax. Now, value of the interest tax shield. Value of the interest, I already explained you the value of interest tax shield. How I have done it? In the previous company I have done this. For this Kroger, value of tax shield I have shown you. So cash flow to the investors with leverage is equal to cash flows to the investor without leverage plus interest tax shield. This is the formula here written. You see, cash flow to the investor without leverage plus interest tax shield. I have written this formula here. So cash flow to the investors with leverage is equal to cash flows to the investor without leverage plus interest tax shield. I have shown here. Cash flow to the investors without leverage is 2327 plus interest tax shield is 168. 2327 plus 168 is equal to 2495. That is equal to cash flow to the investors with leverage. So cash flow to the investor with leverage is equal to cash flow to the investor without leverage plus ITS, interest tax shield. Here is a imaginary scenario given here. If it is 1000 million or 1 billion, if you don't have any debt, you are unlevered. Then what happens? You are paying around 400 million as the tax only 600 goes to the investors. See, whether it is debt holder or equity holder, he is an investor. So, from 1 billion, you are, because not using any debt, you are unlevered. That's why 400 million going to the tax budget, to the tax authority. Your investors are getting 600 million. All right. Vis-a-vis, you are having your competitor is having debt equity mix. Debt holders are taking the interest, equity holders are taking the earning. In total, the total investors are taking 800 million, and tax you are paying 200 million. Then this difference of 200 million, without any debt, you are paying 400 million tax. With the debt, you are paying 200 million tax. So the difference of 200 million is that ITS, interest tax shield, which is going to the equity shareholders or the investors. So debt and tax, value of the interest tax shield, we have up to this discussion we understood. Increasing the cash flows paid to the debt holders through interest payment, a firm reduces the amount of tax. Because of interest, tax is saved. The increase in total cash flows paid to the investor is the interest tax shield, or ITS is equal to, formula you know, ITS is equal to the rate, income tax rate multiplied by interest payment is equal to ITS. So whatever interest you are paying multiplied by the tax rate is the saving in the tax. Cash flows of the levered firm are equal to the sum of the cash flows from the unlevered firm plus the interest tax shield. You have seen here. So the 200 million extra ITS, that became the interest tax shield that is being added. And we have seen in the practical case, in Kroger's case, the cash flow to the investors with leverage is equal to cash flow without leverage plus interest tax shield, 2327 plus 168. The MM proposition 1 with tax. Now MM proposition 1 is with tax, little modified. What is that? Levered firm is equal to unlevered firm plus present value of the interest tax shield. Present value of the interest tax shield. So anytime levered firm value is equal to the valuation of levered firm is equal to valuation of unlevered firm plus PV of interest tax shield. Suppose ECB from example 16.3 borrows 2 billion by issuing 10-year bonds. ECB gives 6% as cost of debt. So 120 million is interest paid every year for the next 10 years. And then repay the principal 2 billion in 10 years. ECB's marginal tax rate is 35% throughout the period. We have seen 35% is the tax rate. By how much does the interest tax shield increase the value of ECB? So here, because 6% in the interest, so 10 years the company has to pay 120 million as the interest. Then present value of ITS is being calculated here, 309 million. Because we are doing in financial modeling course, so like this is not at all required and not at all advisable. Go to the spreadsheet please. Given data here, borrows 2 billion. So 2 billion is given here. Interest rate is 6%. So interest amount per year is 120 million. Alright. Tax rate is 35% given in the question. So interest tax shield, the formula very clear. In tax rate multiplied by interest payment. So interest tax shield will be 42 million every year. It's given here, 42 million every year. So interest tax shield is 42 million. Now what we have done? Year 1 to year 10. This also you need not type 1, 2, 3, right? So year 1 to year 10. What is the interest payment? 120 million. Just we calculated now. 1 to 10. We have calculated interest payment of 120 million. Now what happens? Interest tax shield. We calculate tax rate multiplied by interest payment. Tax rate multiplied by interest payment, 42 million. For last up to the 10 years, 42 million will be the saving for 10 years, 42 million per year the company will save as ITS, interest tax shield, because of this 2 billion debt. The company can go for equity also, but if it goes for debt, then the company has to pay 6% interest. Because of this 6% interest, 35% of that will be saved as tax. That is equal to 42 million. Now, question comes about present value of interest tax sale. You know present value of interest tax sale, present value formula you know. If you don't know, delete one cell and write down present value. Click on the PV function. It is asking what is the rate. Rate is equal to 6% as we know. Freeze this so that we can go further. It will not change. F4, comma, PMT. NPER the number of year. Here the 42 million is in the year 1. So click on 1, year 1, comma, PMT. There is no in between payment, only one payment. So another comma, keep it as it is blank. Future value. Future value we will put in minus because it is in bracket. So minus future value is the tax shield amount 42 million. Bracket close, enter. And once you do that, click right and Control R. So all the interest tax shield yearly we have calculated. The amount of 42 million after 1 year is today 39.62 million. 42 million after second year is equal to today 37.37 million. 42 million after 3 years is equal to 35.26 million today. Similarly, all the today's value we have calculated, present value we have calculated. The total comes as 309.12 million or 309 million. See the answer here, 309 million. So present value of interest tax shield is 309 million. I hope it is clear. Now in the down, okay, so I think this up to this is clear. So this is the way the company saves the tax because of this. If the company issues a bond today, of course the principal repayment will be there after 10 years, but the principal repayment will not have any tax benefit, but the interest is tax shielded. So because of the interest you are paying every year 120 million, 35% of that you are saving as tax. So 42 million you are saving tax. The present value year after year we have calculated. The present value to today's value is 309 million. You are saving by issuing 2 billion. You are issuing 2000 million, 2 billion means 2000 million, and you are saving 309 million out of that because of the interest tax saving. And we have seen in the General Electrical case in the previous chapter, cost of capital, we have seen this. How the one hand you pay the interest, other hand you save the tax. So, interest tax shield with permanent debt. The level of future interest payment varies due to change in the amount of debt outstanding. We have seen in this case, the first point we have seen in this case, in the very first case we have seen, once you are having 0% debt, your cost of debt is 5%. Once you are having 20% debt, your cost of debt is 5. Up to 50%, 5%. Up to 80%, your cost of debt is 5%. But once your debt is 90%, your cost of debt increased to 8.3%. That means if you are increasing too much of debt, cost of debt once after a point of time, cost of debt will go up. We have seen the graph also accordingly. We have seen here. Yeah. So up to 90% debt, up to 89% of debt, it was 5%. Once the debt level become 90%, cost of debt become 8.3%. So changes the amount of debt outstanding, interest rate change. Changes in the interest rate on that debt. So we have seen 8.2 it became. Changes in the firm's marginal tax rate also. Tax rate also might be changed. Then also ITS will be changed, interest tax shield, because interest tax shield is what? It is tax rate multiplied by interest. So rate of interest might change, amount of interest might change, tax rate might change. All these things will change the ITS. The risk that the firm may default and fail to make interest payment, that is also bigger problem, default risk. So the market value of debt is equal to present value of future interest payments. We are not taking the principal repayment because that is not interest tax shield. From interest tax shield point of view, present value of future interest payment. Therefore, present value of the tax rate multiplied by future interest payment, because that is the ITS. ITS is equal to tax rate multiplied by future interest payment. Present value of that, just right now we calculated this for 10 years. We calculated the ITS first, present value of that. So ITS means the interest 120 million multiplied by the tax rate 35% is equal to 42 million. That is the ITS. Present value of that year after year will be the uh, present value of interest tax shield. Or else we can also calculate tax rate multiplied by present value of interest payment, that I have done it down. See what I have done, instead of doing this, I have done the other way approach. Other way through approach is, first I have calculated the interest payment. Interest payment is 120 million, 120 million, 10 years. Present value of interest payment I calculated. How I calculated the present value of interest payment? Simple, use PV. Rate is equal to 6%. Freeze this, F4, click a comma, number of periods, year 1, comma, PMT, there is no PMT, and future value minus 120 million here. Only interest payment I have calculated the present value. Then Control R, all 10 years will be finished. After that, multiply that with the tax rate. This is equal to this multiplied by tax rate, enter, and do this. Control R. You see, same amount come 309 million. So either you calculate the tax shield, after that you calculate the present value. You have done in the first approach. We have calculated the tax shield first, 42 million every year. After that we calculated the present value of the tax shield. Or you calculate the present value of the interest, then multiply with the tax shield. Both will give you the same answer. Equation 16.7. And we come to the basic formula we have seen in the very beginning, that is equal to cost of equity multiplied by weight of equity plus cost of debt 1 minus tax. Weight of debt will be the post-tax cost of post-tax WACC. You see, pre-tax WACC we have calculated. Weight of equity multiplied by cost of equity plus weight of debt multiplied by cost of debt. When we multiply 1 minus tax, we have seen in the previous chapter, cost of capital. When we multiplied 1 minus tax, then it becomes post-tax WACC. Same 16.8 here. Now, what we have done, we separated. The cost of equity before tax is equal to cost of equity multiplied by weight of equity plus cost of debt multiplied by weight of debt, that is the pre-tax WACC, minus RDTC, that is the ITS. RDTC is the ITS, interest tax shield, multiplied by the weight of debt. That will be the reduction of the WACC due to ITS. And leverage and WACC with taxes. The reduction in the WACC increases with the amount of debt financing. More and more you are increasing the debt. If you have tax shield, you are increasing debt, then the WACC will go down. See, said, whatever the cost, whatever the capital structure, in hypothesis, in the beginning, what is said, whatever the cost of capital structure, your WACC remains same, 15, 15, 15, 15, 15, all over the economy. Same here, 15, 15, 15, 15, 15. Why WACC remains the same? Because tax calculation is not done. It is taken as a profit capital market without tax. Then hypothesis works here. If with tax, then hypothesis has given an extension saying that the WACC will go down. The more and more you increase debt, WACC will go down because of the ITS. The pre-tax WACC will be reduced with the ITS factor, interest tax shield, and the WACC will go down once you increase the debt. More the debt, less the WACC. If the debt is more, WACC with tax with less. So more the debt, less the tax. Less the debt, more the WACC. So more the debt, less the WACC. Less the debt, more the WACC. Here is the example given. If you have pre-tax WACC, remains same 15% across the capital structure. But if you have tax into impact, see the continuous orange line, WACC with tax, it goes down. Pre-tax WACC, the dotted orange line, it is 15% fixed across the capital structure. But if it is with tax, WACC will go down once you are increasing the debt in the capital structure. With 10%, 20%, 30%, 50%, 90%, 100%, the WACC is going down. So the bottom line is we can include the interest tax shield when accessing the farm value by either. We have done two approaches here. One approach is we have directly calculated the ITS and make the present value. Approach number one, calculate the ITS, make the present value of that, and you get the total will be your interest tax shield saving in the 10 years. Or approach number two, present value of interest, then multiply with the tax, will give you the ITS, the present value of ITS. Both way you will get the same amount. So 16.4 we will do in the next part. Let me stop the recording here.